guys, welcome back to the channel. It's Dave here. Thanks so much for watching as always. Today I'm talking about Airbnb. It's a company I do own, but I haven't covered as closely as some of the others. Airbnb is an interesting one for me. I bought it a while back. Back then I think I was a bit naive and I would buy things on just on the story of the stock and whether I liked the business model without looking at the underlying numbers enough. And now that the company has had a full year 2022 behind it and we just got those results, which were quite positive for the stock, I thought it'd be a great time to do a deep dive and see what kind of valuation makes sense for Airbnb. Is it a good investment to hold right now and going forward? Should I sell it? Should I buy more? What does it look like for me? So if you're interested in stocks and investing, please do hit subscribe down below if you haven't already. And let's dive into Airbnb's valuation and see if it's a good investment. It went public early 2021, valued around, say, $150 per share. Shot up, was really lofty valuation there for a while, but a lot of companies had that happen after going public, Rocket Lab included. Then it had a rough time, bounced around. It had a really rough 2022, going all the way down to a low of around $80 per share, but it's had a nice bounce lately based on those Q4 numbers, and now we're sitting at just below 140 per share. Quite a wild ride for shareholders for sure. Let's look at where we stand now and look at some of the numbers in depth. So I went through all the yearly numbers for the past 4 years. You can get this on Yahoo Finance or any other investing website. What jumped out first of all to me was 2020 obviously was a horrible year. They had COVID really hurting their business. It was a drop from the previous year, but they have recovered from that. So we're now up to $8.4 billion in revenue from under $6 billion, and yeah, it's a pretty good trend here. We also have the operating income and net income numbers, and we can see that 2022 is the first full year where they've achieved net income profitability. So congratulations to Airbnb on that. Now, overall, I wanted to see what kind of a growth rate we've been looking at over the past 4 years. Just kind of averages out, remove the lumpiness. And over the past 4 years, we can see the average growth rate has been around 18.6%. So keep that number in mind because we're going to need it for later calculations. One thing people don't think enough about is dilution, especially in some of these newer companies. They are often issuing new shares to employees, to executives, to close deals with other companies, things of that nature. And you might think the company is really executing well. Their numbers have been growing a lot, but wait a second, why is the EPS not growing that much? And the answer is they've just issued a ton of new shares that you've not really been noticing. So something always to take a look at, and we're looking pretty good here for Airbnb. Really, in 2020 they were at around 600 million shares. 2021 we're looking at 634, and even down now 2022 we're looking at 631. So they're also mentioning that they have a stock repurchase program, stock buyback program, and that they're going to have about $1 billion in stock-based compensation in 2023, but they'll be at least offsetting that through share repurchases. So we won't have to worry about any dilution at all. If anything, it looks possible that they may remove more shares from the market, and this 631 number could drop even further. So that's something that's nice to see, and a lot of people don't look at it enough. In terms of the outlook for 2023, this is where you can get a lot of ideas on what kind of future growth to expect. Unfortunately, Airbnb is very vague on the future outlook and their growth prospects, so it's a little difficult to model those numbers. But we did see they guided for the same adjusted EBITDA margin in 2023 that they had in 2022. Also, by the way, they have a quite strong balance sheet. We're looking at $9.6 billion of cash on the balance sheet, and that's after buying back $1.5 billion in stock. So they have $500 million left on the current repurchase approval, and they are likely going to do more in the future. They are saying that they're still in growth mode. That's another important point for the future to keep that in mind when you're thinking about your valuation, and that they plan and can and use this balance sheet to invest in growth for the business in the future, as well as potential mergers and acquisitions. So maybe buying other companies and adding to the growth that way. So what is this EBITDA margin, by the way, that they said is staying the same in 2023 as 2022? Well, we did the math. We had 8.33 billion, 8.39 billion in revenue versus a little over 2 billion in EBITDA. That means the EBITDA margin was 24.93% or just under 25%. So that's the number I plan on using for EBITDA margin in my model. And just a question to ask yourself, always important, is this company getting towards a more mature stage where they're not growing as quickly? Nothing grows forever. Eventually, you need to level off. No business can keep growing in perpetuity. So if you think that they're reaching maturity and the growth will slow, you need to keep that in mind for your calculations. However, they did say in the earnings call, this is a quote, I have a long list of things that we can invest in to drive further profitability. So at least the management of the company does not seem to think that they're reaching that end stage where they're no longer growing as quickly. And that is something I'll take into account when I'm looking at my valuation. So now that we've pulled that information from the earnings call and the full year numbers, let's dive into a spreadsheet and see if we can chart out what kind of valuation the numbers might justify. Okay, so I just wanted to go through this spreadsheet model with you. It's pretty basic, easy to understand, but it's a great model to do for any company you're investing in. So to start off with, I pre-populated all our numbers from 2022. You can see the revenue number we mentioned previously, as well as cost of goods sold, SG&A, R&D expenses, and then you end up with the EBITDA number that we mentioned previously as well. And then after tax, we can see the net income number. Now, we saw the compound annual growth rate of the company over the past 4 or so years has averaged out to about 18.6%. To be a little on the safe side, I said that going forward, let's look at 15% growth rate, and just to give myself some numbers for the future, I thought that was a reasonable number. You could increase it if you think they're going to grow more quickly, or decrease it if you think they don't have that much growth in them. Totally up to you. But for 15%, we can see the numbers we're looking at for revenues all the way out to 2027. Now, you could try and estimate all these numbers, SG&A, cost of goods sold, R&D, and then come out with an EBITDA number. But they already told us for 2023, we're looking at the same EBITDA margin that we were looking at in 2022, as we saw previously. So I jumped straight to that EBITDA number and calculated it out based on similar margins. And then we landed on about $2.4 billion in EBITDA for next year, or I should say this year at this point. And then we calculated that all out just using the same margin, just to be simple, to 2027. If you go in depth, you may expect the margins to improve as they scale better and better. So potentially you could improve these numbers as well, but I would like to play it safe in all of my models. So I kept it the same as today. So we're looking at revenue improvement for the next 5 years, but no margin improvement. It will stay the exact same according to this model. Now, of course, you subtract out taxes, and we're looking in 2027 a net income number of $3.621 billion. So that would obviously be profits. Not too bad for any company, obviously. So after that, let's look at this $3.6 billion number, and we have to decide how much that is worth in the future. Starting off with, let's just say a price to earnings multiple of 25. Assume in 2027 that's the multiple they get. That means that the terminal value in 2027 that the company is valued at would be $90 billion. So What is today's value for that? Well, how much is money worth to you? If you're investing for 5 years in the future, you want to see a certain amount of return over those 5 years. The time value of your money is a certain percentage. You can plug this number in, change it as you want. I put 7%. I think that's reasonable to expect, a 7% return on the market overall. It's a pretty reasonable number to me. I've seen lower, I've seen higher out there, and obviously a lot of things can go into this number, including the overall stock market climate. It's another number you can change yourself. As you can see, every number can be changed depending on how you think the company will do in the future, how the markets will be performing in the future, and that has a massive impact on the potential future value of the company. So if you take out 7% a year, you're ending up with today's value is just under 70 billion, and in the future it would be 90 billion based on a 25 times price to earnings multiple. That would mean that this valuation is actually not that amazing right now. Our current share price is around 138. We'd be looking at a share price of 142 in 5 years. So basically flat over a 5-year basis. That's actually a horrible investment. So if this is what you're expecting in terms of a price to earnings multiple, if these numbers are what you believe in terms of how fast they will grow and how the margins will stay, then I would say this company is a sell. You have to say it, right? But we can change a lot of numbers. And before we go into that, I'd like to show you guys some comparables so we can think about what price to earnings might be reasonable for this company. So I have a handy dandy chart here. This is net income in billions over the past several years. And we've got a few different companies to look at. We have Expedia, Uber, Marriott, and Airbnb. So Airbnb is this dotted yellow line here, Marriott is the solid blue, then Expedia is this dotted reddish line, and Uber is dotted green. Airbnb has not been public for that long, but they've made some great strides really, so I'm just going to trace out the line in red here. They're still under Marriott, but they're getting quite close to catching up to Marriott in terms of net income on their quarter. Uber obviously had a very rough run of it. They almost hit profitability in terms of net income, but it seems in the past year they've really taken a nosedive on that metric. So not too sure what's going on there, but Uber's not a company I've been a huge fan of lately. So it's hard to compare them to Uber on net income when they're negative. So Uber has no price to earnings because they don't have earnings. But in terms of their biggest competitor, we're probably looking at Expedia. They own Vrbo. You've probably seen a lot of the commercials for Vrbo. It's like the biggest competitor to Airbnb, and really kind of a similar business model as well. We have Marriott. They're what you might think of as a more traditional hotel chain. They have a price to earnings here of just under 25. So if you think in 5 years, Airbnb is going to trade kind of like a hotel, and it will have that kind of growth ahead of it, then you might value Airbnb at a 25 price to earnings in 5 years. Right now, Expedia is 50, obviously, and Airbnb is 44. So tech companies can often have higher price to earnings multiples. We've seen Tesla have ones like way up in the hundreds. I'd like to keep mine a little lower. I don't like to assume that the market is going to give a company a price to earnings, 100 or above, even though it does happen sometimes. So if you think Airbnb is a tech company and not a hotel, you might be more willing to give it a higher price to earnings number, as tech companies often have faster growth and do justify those higher multiples. However, if you think it's going to be more like a traditional hotel, we're looking at around 24. So with that in mind, now let's head back to our chart and play out some different scenarios. Okay, so our bear case here is basically a $25 price to earnings multiple. You would say that, at the end of the day, Airbnb is basically a hotel. I don't see why they would grow any faster than a hotel chain. Let's give them a 25 like Marriott has, and you'd get a terminal value per share of 142, around what it is right now. So I would have to say, if you think that's the case, Airbnb is a sell. However, if you give it a higher number, let's say something like a 35, you think they're still going to be growing into the future past 5 years from now, which the executives seem to suggest. They seem to suggest there's still a lot of growth ahead of them. Then you're looking at a terminal value per share of 198. So in 5 years, we would be looking at $198 per share, whereas right now we're at 130. So now we're talking about a decent investment, not amazing, but decent. If you think that their price to earnings multiple will stay around 44, they'll still have similar growth prospects and the multiple's not going to compress at all, then we're looking at a 250 in 5 years, which is pretty great return, not quite a double. I think a lot of us have gotten a little spoiled by some of the crazy returns that we saw in 2021ish. We had a big run up for a while there, so I think some people, when they don't see at least a double, they get a little dismayed. But by any measure, like a 2x in 5 years, a 90% return in 5 years is still very good, especially in a company that is safe and has a solid balance sheet and a lot of cash on hand. So you don't always have to look for that big home run that's a really risky company that's really going to pull through and a lot of people are counting out. There's nothing wrong with investing in a safer company. Now, let's say if they're doing well, they're growing well in the future, we'll give them a 50 price to earnings multiple. Then we're looking in 5 years at 284. Now that's a double from today, so that's pretty good. If you think even better, you can say 75. I don't think I would go that high. I don't think I would go above 50. I don't tend to like to do that because that is getting into a pretty rich valuation, especially for a company that's been around for a little while. But if you think they can justify that in 5 years, then we're talking $4.25 per share. That's like a 3x. So you can obviously plug in your own numbers there, get what you want. I would probably land on maybe a 40, so a little bit of multiple compression, but still some growth in the future. And I think it's pretty reasonable. We're not talking crazy numbers here. Some companies have had hundreds of 100 plus ratios. So to me, this looks like a pretty solid investment, not super exciting at these numbers, but pretty solid and not too bad, really, all things considered. But let's head back and wrap up the discussion. Going through all those numbers, I think it really helps you to get to know the company, get to know where it's a good deal and where it's not. So definitely back when we were looking at $80 per share, I think it's fair to say that was a pretty good deal. Right now at $140 per share, I would say I'm going to continue holding my shares. I'm not ready to sell right now. I think it's still an interesting company, but I'm also not going to buy more. So maybe a hold or an outperform right now if you go into those kind of ratings. But it really helps you to know what's a good value for the company and not just glancing at the historical chart and going off of how it's traded over the past year or so, because that's not always the best measure. Sometimes companies can be trading at irrational levels for extended periods of time, and you really want to know whether that's the case. For me, I'm continuing to hold the company. I like the CEO. I like the business model. There's been some brand damage recently, perhaps, where a lot of people are not very happy with things like cleaning fees, which they think of as more like hidden fees that are not always for cleaning. Some hosts have had problems with guests damaging their property, things of that nature. There's always going to be problems in the business, and I do think they need to take care to ensure they still have a good brand in the future, but they have had a good 2022, and now I know if it drops, to $100 a share again, that's definitely a level I would be very comfortable adding more shares at. So let me know what you think of the company down below. Do you own any shares? Are you thinking of buying? What do you think the company is worth? And if you haven't already, please do hit that subscribe. I hope you guys have a great week. I'll see you in the next video. Bye for now.